Why are Americans so concerned about the state of the stock market? In today's audio content, we'll dive into some key highlights regarding the stock market, its recent fluctuations, and what it means for the everyday investor. It's been quite a roller coaster ride, so let's break it down and see how it might impact stock prices. First off, let's address the elephant in the room, investor sentiment. Recent data shows that over 50% of market participants have turned bearish on the stock market for the next 6 months. This is a significant shift in sentiment and is often seen as a contrarian indicator. Historically, when more than 50% of investors are bearish, it tends to signal a potential market bottom, and markets tend to perform well in the following months or even years. To illustrate this point, let's look back at some historical examples. Back in March 2009, during the depths of the financial crisis, we saw a record 70% of market participants being bearish for the next 6 months. What followed was a tremendous bull rally that lasted for several years. Similarly, in 2022, when many were predicting doom and gloom for the market, sentiment showed between 50 to 60% of market participants were bearish, and yet we witnessed a significant rally, especially in stocks that were expected to perform poorly. So, with the current bearish sentiment, one might interpret this as a potential buying opportunity. The crowd is often wrong, and going against the prevailing sentiment can lead to profitable investments. Now, let's talk about a lesser-known but crucial stock market index, the Russell 2000. While most people focus on the Dow Jones Industrial Average, S&P 500, and Nasdaq, the Russell 2000 often provides early signals about the market's direction. When the Russell 2000 starts to decline, it can be an early warning of trouble for the broader market. On the flip side, when it starts to rally, it's a positive sign. In recent years, the Russell 2000 has been relatively flat, which is indicative of an unhealthy market. This stagnation can signal underlying issues in the economy. It's essential to watch this index because it often leads the way, showing us whether the market is on a strong or weak trajectory. But there's a silver lining. Small-cap stocks, which the Russell 2000 represents, are currently undervalued, and undervaluation can only persist for so long. The stock market moves in cycles, and historically, periods of undervaluation are often followed by strong rallies. So, for investors looking for opportunities, small-cap stocks might be the place to focus on. One stock that has been making headlines recently is Powell. Powell has shown impressive growth in its Q3 revenues, with an annual growth rate of over 24%. The company's commercial client count has also grown significantly, marking a 45% year-over-year increase. These numbers highlight Powell's impressive performance. Meanwhile, the stock has been on a tear, with a 113% gain, making it one of the top-performing stocks in the market. The question on many investors' minds is whether Powell can overtake larger tech giants like Meta, formerly Facebook. While it's not certain if Powell can sustain its growth and eventually secure a spot in the S&P 500, it could potentially outperform other tech stocks. Now, let's shift our attention to Fubo TV, a stock that had a stellar week, gaining over 37%. This impressive rally followed a prediction that the stock would reach $3 per share, which remarkably ended up being spot on. Fubo TV's recent performance indicates growing investor interest in the stock. When we examine Fubo TV's financials, we see a mixed bag. On the positive side, subscription revenues and advertising revenues have both grown significantly. However, subscriber-related expenses and sales and marketing expenses still need optimization. The company is making progress in narrowing its net loss, which is a positive sign. If they can continue this trend, it could signal a turning point for the company's profitability. One factor that has been influencing the stock market's recent behavior is the Federal Reserve's stance on interest rates. Jerome Powell's recent statements suggest that the Fed is unlikely to raise rates further in the near future. This decision has been positively received by the market, as it removes the fear of rising rates that have been negatively impacting small-cap and money-losing companies. This change in sentiment has also been reflected in the performance of fintech stocks, which have seen significant rebounds in recent days. Square, Upstart, Affirm, and other fintech companies have witnessed strong recoveries. The market seems to be hoping for a Goldilocks period of steady interest rates, which could provide a conducive environment for growth. Another factor worth mentioning is the state of commodities and oil prices. The GSG Commodity Index, which reflects the performance of commodities, has seen a significant drop of about 5.7% over the past year. This decline, along with the stabilization of oil prices, indicates a potential reduction in inflationary pressures. It's crucial to watch these indicators as they directly impact inflation, which can, in turn, affect interest rates and stock market performance. Speaking of inflation, recent data shows that the Consumer Price Index, CPI, is around 2.35%. While this is the government's official number, true inflation might be higher. Considering the current state of commodities and housing, it's reasonable to expect that the CPI will gradually approach the 2% range, which could have implications for the stock market and interest rates. As for unemployment, it's crucial to understand the context. Unemployment has risen to 3.9%, up from 3.4% at the beginning of the year. This might seem alarming, but it's important to remember that it's a reaction to the perceived overheating of the economy. The Fed had initially predicted a potential rise in unemployment as part of its strategy to cool down the economy and combat inflation. It's all part of the delicate balance of economic management. Now, what does all of this mean for stock prices and demand? Well, it's a complex interplay of factors. The market sentiment suggests that we might see more opportunities in small-cap stocks, and if inflation remains in check, it could provide a favorable environment for stock prices to continue their upward trajectory. However, it's essential to keep an eye on inflation, interest rates, and economic indicators, as these can shift the market's direction rapidly. So, how are these market dynamics affecting your investment decisions? What stocks or sectors are you keeping an eye on in this evolving landscape? Share your thoughts in the comments below. In conclusion, the stock market is a complex ecosystem influenced by a multitude of factors, from sentiment to economic indicators. Understanding these dynamics and staying informed is crucial for making sound investment decisions in these ever-changing times. The information provided in this audio content is for educational and informational purposes only and should not be considered as financial advice. Always conduct your research and consult with a qualified financial advisor before making any investment decisions.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information. And it helps us spread the message. Sharing is caring.